Hello, I'm Todd Clark, and welcome to our monthly market review. No bones about it, September was a tough month. And to discuss the challenges of September and the opportunities that lie ahead in the fourth quarter, let's turn to our Chief Investment Officer, Rusty Vanneman and Paula Week.
Thanks, Todd. So, Rusty, what happened in the markets over the course of last month?
It wasn't a great month.
Right.
I mean, it was a tough month for the stock markets, both here and abroad. It was a tough quarter, too. I mean, we had our first correction since 2011, our worst quarter since 2011. So it wasn't great for the stock markets.
No, it wasn't, but fixed income did hold up pretty well.
Great point. Fixed income did really well. I mean, that's the most hated asset class, and it's now outperformed stocks both last month, for the last quarter, year to date, and over the last 12 months.
So, what were some of the things you were seeing that happened last month? Why did markets underperform?
Well, let me hit some reasons I think are both overrated and then some reasons that are underrated for losses. I think, well, two of them we talked about last time we were here together, and I think the concerns about growth in China slowing down is overrated because growth is still strong there. It's in absolute terms, and we've kind of known about this slowing growth for a long time, so that's overrated. I think another reason is that concerns the Federal Reserve is going to raise interest rates. Have we not known this for a long time? I mean, they are going to raise rates at some point. Another reason that just came up late last week is the unemployment situation. We had a number that came in below expectations, but man, talk about a lot of noise on that. I mean, it did come in below expectations. Sure, it did. But the numbers for payroll growth this year is still about 200K per month. That's great.
Right.
And of course, we're 6 years into economic growth, so you're going to expect a little bit of slowing there anyway. Unemployment rate's at 5.1%. That's a great number by any historical standard. So I think that number is way overplayed. So here's what's underrated. So one thing that's not getting enough play is corporate earnings growth. I mean, it has been negative. It's been trending lower here for a few quarters. It's expected to be about negative 10% year over year this quarter and next, and about negative 3% for the year. That's a big deal. I mean, that is a reason why that the markets are a little bit soft. Another reason, which I'm surprised hasn't get more play, is the seasonal factor. We're usually coming, this is the weak quarter, the third quarter. Of course, that sets the stage for the fourth quarter, which is usually the strongest. So
Absolutely.
Those are some of the reasons, yeah.
Absolutely. So what can you tell investors about what's happening in our portfolios?
Well, let's see. So something that's worked relatively well for us this year is high quality. And for exactly the reasons, I mean, it's really played out the way we said it would, is that if economic growth is slowing, higher quality companies should do better. They have more consistent profitability. They have stronger balance sheets, higher dividend growth, all those things that should hold up better, and they have been. They're typically large companies. They tend to be growth companies, and large cap growth easily the best performing segment of the market this year. What hasn't worked well is our theme in emerging markets. And, I mean, earlier this year it was the best performing asset class, but it's not now, and that's been hurting us. But we've talked about we like it for better growth, we like it for better valuations, but I think there's another reason why to like emerging markets right now, and that is sentiment is so negative on the asset class. And let me just kind of go through some of those stats. So when you look at forecasts for revenues and earnings, the worst expectations since 2008. You're seeing a lot of downgrades in emerging market space, the worst in over 10 years. Just sentiment surveys are just really negative. Flows were the strongest outflow since 2008. Actively managed funds have their biggest underweights in emerging markets in many years. So you just add it up. This is like the most negative it's been since 2008 for emerging markets.
And then when sentiment was this negative back in, let's say, 2009, you could actually look at how they performed. Emerging markets were up over 70%.
That's a great point. So you're absolutely right. They're up 70% in 2009. So I think being a contrarian in emerging markets can make a lot of sense. So those are our big positions, and we continue to hold those moving forward.
Thanks, Rusty. And thank you for your time and trust in CLS Investments.